it's turning out to be a pretty strong day of trade, no two ways about that. There are a lot of stocks hitting fresh 52-week highs. ITC is at a fresh high this morning, almost 300 rupees over there. So the volume's also picking up on ITC. You have some of these auto stocks that are sitting at fresh highs. TVS Motor has been at a fresh 52-week high for a while. So is Eicher Motors. Bajaj Auto has hit a fresh 52-week high today. So things are looking pretty good in the consumption pack. But in a major relief for oil and gas companies, the government has cut the windfall tax on crude oil profits to 17,000 per ton from 23,259 per ton earlier. The government has also reduced the export duty on diesel to 10 rupees per litre from 13 rupees earlier and 4 rupees per litre on ATF from 6 rupees earlier. So the export duty has also been cut, which is a positive. Sonal is here with what brokerages are making of this move. Sonal, over to you.
Let me start with what Morgan Stanley says. They say that it's a $10 per barrel improvement as far as taxation is concerned, and it will be a reduction by $10 per barrel. Oil producer tax reduces to $30 per barrel now, and SEZ refineries, they are also exempt from export taxes, which is of course a big positive for something like Reliance Industries. In absolute terms, however, they think that the windfall taxes are still very high, and if there is more reduction in product prices globally, there is steady normalization in local fuel availability, there's stability in oil prices and more normalized global fuel margins and currency stability, then they expect windfall taxes to reduce further. As far as ICICI Securities is concerned, they think Reliance Industries is the key beneficiary of these measures. There could be a $4 to $4.50 per barrel duty impact or benefit due to these reductions. For ONGC and Oil India, the reduction in duties, it is in line with what the crude prices globally have been doing. So there is a natural cap on their net realizations at $70 per barrel, which is now unchanged. However, the proactive monitoring that the government did, they went ahead and reduced taxes when global prices were lower. So that gives a comfort as far as policy is concerned. Lastly, talking about Nomura, cut in export duties and exemption from export duties for SEZ refineries would lower the impact on Reliance's GRM by $2.3 per barrel. They do not see much impact on their estimates of GRM, so Reliance Industries, that is at $13 per barrel. The reduction in windfall cess is of course a positive for the upstream companies, and this will likely offset the lower net oil realizations that these companies are seeing because crude prices have come off. All in all, it's a positive for all these three stocks.
It is a positive for all these three stocks, and we're seeing that in the way these stocks are moving as well. Reliance, as we speak, has once again started to accelerate, moving towards the high point of trade. ONGC as well as Oil India doing well too. Probal Sen, the energy analyst at ICICI Securities, joins us now. Probal, what have been the numbers that you've been working, and with the moves that we've seen in these stocks already, do you think the positives have been factored in already?
I think given that a lot of this impact is more around the message that got sent out with respect to the taxes that were put, I think the positive reaction is also a function of the fact that the government has done exactly what they had promised, that they would review it in a fairly short period of time. I think they had mentioned 15 days review would happen. And the fact that it has happened as guided, and it is fairly proportional to what international prices have done both for crude and product spreads, I think that is the more welcome measure that seems to be reflecting. As far as numbers is concerned, frankly, Singapore margins have actually come off quite a bit. If you really notice, Singapore GRMs have dropped to around $7 a barrel from a high of upwards of $25 just a couple of weeks ago. So to that extent, it still remains uncertain in terms of what the benchmark margins themselves would behave. But now we at least have the confidence that if the market scenario continues to remain muted for refining margins, the government will correct these duties and these anomalies, and therefore Reliance and all the other players can continue to deliver margins in line with international trends rather than completely being off kilter due to these export duties. I think that's the bigger point.
Sure.
As far as upstream is concerned, of course, as I said, there's a natural cap that develops. I think they mentioned at $110 odd when the duties were put that we would relook at this at $40 and remove it, which obviously meant that $70 is something they are comfortable with letting upstream companies do, and that is what has played out in this cut as well. So that at least creates visibility on the minimum realizations that ONGC and oil can make.
Okay, all right. That point is taken. So the minimum realizations of $70 for the likes of ONGC, Oil India, and the fact that there is some amount of policy there's some affirmation that policy has been reviewed as per what the government guided for. That point is taken. But what about Reliance, Prabal? Because, everybody is gung-ho on the fact that Reliance would be the biggest beneficiary. Combine that with the fact that it's coming out with its earnings on Friday. How are you approaching the stock?
Well, I think we frankly have an ad rating on the stock, but that is not, but we continue to believe that Reliance will deliver far and away the strongest earnings of any company in their market cap range. We continue to build in a 20% plus kind of an earnings CAGR over 22 to 24, and this is still built on only about $10 to $11 of GRMs. Now, one can argue that that number could be lower by a couple of dollars here and there, but broadly speaking, our numbers are not really very aggressive for OTC. And despite that, with everything coming together for various businesses, their earnings growth remains superior to anybody else in the space. Obviously, this clarity and these measures are an additional driver. We would expect that, we would get more visibility on how the green energy business is shaping up over the course of these 12 months. I would expect that in the AGM also, we perhaps could get some sort of, clarity or some more details. So that is another driver that can come through. And the consumer businesses anyways continue to do fairly well. Retail is looking fairly strong. Jio's numbers, I think in this quarter, they will probably report a net subscriber increase for the first time in 3 quarters. So that's another monitorable to look at. So from earnings standpoint, I think there's a lot of comfort.
Coming back, sure. From earnings standpoint, there's comfort. I get that. Coming back to this windfall tax cut, Probal, I agree that this is a positive move by the government. The tax has been cut, etc. But don't you think this ad hocism is something that could keep a lid on the gains for these stocks? I mean, it's still not it's still a fixed tax, right? It's not ad valorem, which makes it problematic given the volatility that we're seeing in prices. Your view?
Sorry, go ahead. Finish your question. Sorry.
No, that was my question. I mean, this ad hocism, because, we were speaking with R.S. Sharma also a while back, and he said that just make it a transparent process completely. I mean, as of now, there is a relief, but as an investor, you don't know what to expect, right? 12 months or 6 months down the line. Your thoughts?
Absolutely, which is why I mentioned that the government actually sticking to the fact or sticking to their words in terms of reviewing it at the time that they mentioned was perhaps very important. Precisely because of the reason that you mentioned. If it is meant or if it is changed to an ad valorem level, obviously there's a lot more visibility that happens and it's more predictable and it sort of reduces the need for government intervention per se. So that would obviously be an ideal situation, but one has to really look at where we are and at the margin, how are things actually changing. So I can only sort of tell you that, at the margin, if this review and this proactive changes in line with what international prices do continues to happen, that is a positive from where we were, let's say, a week ago or a couple of weeks ago. We can discuss whether it should have been ad valorem in the first place, but then that's neither here nor there, unfortunately.
Okay.
So with all these things which are, so many moving parts, so to say, what would your medium-term and long-term call on the non-Reliance oil players be? Say something like an ONGC, Oil India.
Well, ONGC, sorry, I apologize. We don't have official coverage, so I can't comment on the rating. Oil India will remain fairly positive, particularly in this situation now that there's visibility on a minimum floor and the fact that even at the current environment, NRL's GRMs can continue to actually fuel their consolidated earnings. And plus the fact that, even the working of a low base, we do believe that Oil India can report reasonably, speaking 1 to 2% production growth over the next couple of years. So we remain fairly positive on Oil India's prospects. Other than that, on the OMC space, I think IOCL probably is a preferred pick. It provides a good balance of mix between refining and petchem earnings, as well as the fact that subsidiary CPCL's numbers have been looking fairly strong. So that also provides an additional hedge if you look at the resilience to the weakness in marketing margins is concerned. So those are the 2 oil names that I would look at. In gas names, we like GAIL and some of the CGDs. Like IGL and Gujarat Gas.
Okay, you like IGL and Gujarat Gas, GAIL in specific?
Well, I think for GAIL, the fact of the matter is that, the hit from higher gas prices is felt only in petrochemical segment. Now that, we are talking about domestic gas prices also coming under some sort of a review or remaining, even if they increase to about $9 or so, we do believe that whatever hit they take in EBITDA from LPG and petchem can still be made up by the very strong trading segment prospects.
Sure.
Given the different.
Sure.
Yeah.
Sorry to interrupt you, but just one quick question. Since you were talking about Reliance earlier, and that's going to be the big stock in focus, right? All eyes will also be on what comes out of the AGM, because there's an expectation that there could be some announcement on the renewable business stake sale, any concrete timelines on the IPO of the consumer business. Is that just hope, or do you expect something concrete this time?
Well, there's always hope. When it comes to an AGM, it's become like one of the box office events of our sector. And it's very difficult to sort of separate, what is a concrete fact with, what is hope. So, our sense is that even if we get some sort of an update on how the initial plans have actually played out, if you remember, the initial plans were very clearly mentioned that, solar would be the key focus area to begin with, and the repurposing of the petcoke gasifier plant to produce blue hydrogen. So, whatever details we can get in terms of whether investment plans or timelines around whatever is happening on solar and hydrogen, those would be welcome. This listing, hope in terms of consumer businesses, I've been hearing for the last 3 AGMs. Frankly, I have no insight into what MD might be thinking or about announcing or not announcing. So wouldn't really want to speculate on what will happen on that front.
Okay, all right, Probal, we're going to leave it on that note. Thanks very much for giving us your views in the oil and gas space. Thanks a lot for joining in this afternoon. Well, we need to take a short break with the news that the Nifty is holding up with a gain of over 200 odd points. The Sensex close to 800 points in terms of a rally. Up next, Aditya Agarwal